Yet another week of yo-yo business headlines has gone by. Stock markets danced a slippery tango. GDP data, which reflects the state of the economy, came as a silver lining. But the dark, moody clouds surrounding savings and investments are refusing to go away. Welcome everyone to Let's Talk Money, and this is what we will unwrap today on the show. First up, India stays at the top of the growth table with 7.3% GDP rise, beating China's 6.9% figure for the December 2015 quarter. Then why are investors still a worried lot, and why are stocks falling? Which of course is also impacting your mutual fund portfolio. This worry also seems to be seeping into our savings, which as a percentage of India's GDP have dipped to 30% over 5 years from 37% in 2007-8. What can the finance minister do in the union budget to stem the fall in savings and return investor confidence? Joining me today to decode these headlines and numbers are Nilesh Shah, MD and CEO of Envision Capital Services. Thank you so much, Nilesh, for making the time. Also with me here in the Delhi studio, Dhirendra Kumar, CEO Value Research. Dhirendra, pleasure to have you with us.
Thank you.
Okay, gentlemen, let's start with the GDP figure. We've promised to actually make this very, very simple and keep it away from jargon. So here's what GDP, or gross domestic product, really means. It broadly measures all economic activity of a country. Nilesh, over to you first. Everyone's questioning the GDP number and saying that these numbers absolutely don't look believable. Corporate results, which tell you how corporates are doing, have been very depressed. Your exports are not picking up. You also have things like investments not picking up. So how are the GDP numbers looking so good?
Well, I think there's always a fair bit of skepticism in terms of how you read some of the macro numbers, because it's honestly pretty difficult for most people to kind of really figure out how the GDP numbers are calculated. But clearly, I think there are some three broad constituents to this, the way the GDP numbers come out. There's agriculture, there's industry, and then there is services sector. And most of the people are associated with the agricultural and the industry sector, but the real growth is happening on the services side. The services side is large, but it's not yet large enough in terms of common understanding and what you look around. So to that extent, the numbers, in a way, there is a sense of disbelief as far as these numbers are concerned. Number one. Number two, there's some bit of seasonality to these numbers. And three is, of course, there's always a base effect which is entailed with the GDP numbers. And that's true for most of the statistics which come out. So I don't think there should be any sense of a disbelief in terms of that whether India is growing at 7.5%, because there's so much which happens outside the listed space. I mean, what we normally come across are the numbers of listed companies. Of course, some of them are very large, but we also see that there is a huge segment which is outside the publicly listed companies. Businesses which are done by the government, businesses which are done by the small and medium enterprises, businesses which are done by some of the unlisted companies, especially some of these very big digital, internet and consumer companies. So to that extent, I wouldn't kind of brush off these numbers as numbers being unbelievable. I think if you were to kind of look at a lot of other evidence, if not close to 8%, but we seem to be definitely growing at about close to 7%. So to that extent, I think there is fair bit of economic activity, and I think numbers around 7% are, I would say, reasonably true.
Reasonably true. Okay. Would you believe that, Dhirendra? I mean, this whole skepticism around GDP numbers is a bit overplayed. There is a whole universe outside of the stock markets which could have powered this, because overall itself, people are questioning whether this is investment-led number.
No, I don't think there is any reason to doubt this number, because CSO is credible. There is a reason why this greater, why we have a cynical view of this. The reason is very straightforward. There has been a change in methodology, not very long back, and we seem to be, the change in methodology is very much in line with the global standards. That is what the world wanted, and that is what we have done. And RBI governor has added to the skepticism that he said that this way how the GDP number can actually get exaggerated, explaining that example of two wives exchanging their kids, taking care of their kids and exchanging money, and that can actually boost up. So that particular thing only added to it, and I think that is a methodological problem. That is how it is done worldwide. He was citing about another example, that if you have food at home and if you have food at in a restaurant, the gross value added is the same, but then it gets added in the GDP.
Do you believe that at least we are the fastest growing economy currently?
In a limited way, yes, and but that is no consolation, because we could be fastest growing while all others are in dumps, and you can be very pleased about it, but that doesn't necessarily cause cheer among ourselves.
Okay, Nilesh, we could be fastest growing when everybody is down in dumps, and that's not an hypothesis enough for us to be cheerful. My question to you is, would that not mean then monies at some point in time actually finding ways back into India's stock market? But nobody, at least all the market players, are not convinced about that argument at all.
Well, this is the nature of the beast. This is the way the markets are. So probably 12 months back, 18 months back, everybody was so cheerful, and the only place where everybody wanted to be was the equity markets or the stock markets. And today the sentiment is a complete reverse. But Manisha, these are really the best of times to invest. The best of times to invest are when there is despondency, there is disappointment. You get to own stuff that you want to own for the next several years at steep discount. A lot of stocks are off 20, 30, 40% from where they were 6, 12, 18 months back. So clearly, I think one should really not go with what is the popular wisdom at this stage. And I think you should probably go with a school of thought which says that yes, India is growing at about 7 to 7.5%. Corporate earnings will pick up soon. The whole downturn in the commodity cycle is going to boost corporate profitability, and therefore over a period of time there will be value creation, and therefore equities and its asset class should deliver returns which are reasonably better than the other asset classes.
Okay, fair enough. Now my question to you, and here I'm going to come to you, Dhirendra. Equity as an asset class, we hear this every time the markets come down, and they've given us plenty opportunities since 2008 of being able to be bought into. Yet if I look at the percentage of money which is going into equities, its retail participation is extremely poor, and there is this inherent worry that financial markets just do not reward retail investors.
That has largely been the experience of the individual investor, because that is how behaviorally we are configured. A lot of things to be blamed for this. One is the way financial services is, the business is conducted. It is easy to sell. Like today, if somebody is trying to hawk equity fund, he will have a hard sell. And it was very easy 6 months back, 1 year back.
Absolutely. And when the markets were high, equity funds were seeing huge inflows.
Yeah, but this time it's little different. That we have a sizable SIP book, 4,500 crore approximately coming into mutual funds, steadily over month, which is unlikely to be very disappointing for investors. That also creates an avenue. I think it is more of a behavioral treatment, because when you invest 5 lakh rupee and you see it turning into 4.5 lakh rupee, you are only waiting to exit.
Okay.
And that has historically been the case. Last 25 years I have been watching investment and mutual funds.
Nilesh, do you have a better strategy for people out there who would like to enjoy the equity returns, be able to see some gains, not follow the herd of investing when the markets are really high and getting extremely pessimistic and pulling out money when markets are low? I mean, how does a retail investor tackle this cloud of pessimism which is surrounding him?
Well, I think there are 3 very important attributes that you need to kind of be a successful investor: patience, discipline, and judgment. I think these are the 3 broad factors which determine essentially your success in investments. And I clearly believe that SIP as an instrument is a fantastic instrument to kind of really be able to ride all the 3 attributes which are required.
Nilesh, then I have to ask you one more question. I read a very interesting article, and they said, you keep doing SIPs, but as the markets are going up, you would probably want to bring down the amount of money you're investing in, and as your markets are going down, you could probably increase. So the amount that you're putting in your SIPs or your mutual fund investments should go up when markets are going down. Would you go with that theory, the ladder down approach?
Absolutely not. No, I don't think so, because I think at the individual level, I'm sure none of us are so insightful to really figure out when markets are going to go down, how much they are going to go down. I think these are very, very difficult decisions to make, and probably this requires more of luck rather than being smart, being intelligent, or having the intellect to be able to take these decisions. I think what is very much required is to make some very simple decisions, that what is the kind of surplus funds that you have for the next 5, 10, 15, 20 years, and then to keep allocating those surplus funds to the right asset classes, and within that to be able to make the allocation to equities. I think trying to kind of really figure out when markets are going to go up or when they're going to go down and take your allocation decisions based on that, I don't think is a very great or a prudent idea. I'm not too sure whether this is a time-tested idea. And if somebody had this kind of capability, then I don't think he should be giving his money to professionals. He should be able to invest directly in the markets and buy and sell stocks.
I think you've said it all. Okay, Dhiren has a point to add here very quickly. Dhiren.
When you least expect it.
Absolutely.
And that is something which is hard to guess. But these things should be done. These are prudent things. Diversify, invest regularly, rebalance, and put on your long-term money. I don't think these are negotiable things.
So these are non-negotiable thumb rules for investing. So whether you're decoding big business headlines, getting worried about it, the fact of the matter is that you just have to follow very, very simple premises to make sure that your wealth actually grows. If you've got a question on your portfolio, you can write into us, and we will get some of the top experts coming on Let's Talk Money to help you with your portfolios. And of course, when we come back, the other big question that we've been wanting to ask and get an answer to: why are households nervous? Why are savings as a percentage to GDP falling? And can the finance minister do anything about it in the union budget? Remember, we're in a run-up, 2 weeks to go. And what could be the answer from the FM? Stay with us. You're watching Let's Talk Money.